Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, we're going to look at Treasury shares, also known as Treasury stock. Treasury shares or Treasury stock refers to a portion of the company's shares that were issued and subsequently reacquired by the company. Treasury shares are not considered outstanding, they do not pay dividends, and they do not have voting rights. A very easy way to think of treasury shares is to think of them as shares that the company holds in its treasury. Now let us look at the methods in which companies acquire treasury shares. Number one, buybacks. When a company buys its own shares from the open market, it acquires treasury shares. The second method by which a company can acquire treasury shares is forfeiture. Individual investors can forfeit their shares by failing to meet certain obligations and conditions. The third method by which companies can acquire treasury shares is through donations. Some investors might decide to donate part or all of their shares to the company. Now, you might be wondering why a company would consider buying back its own shares. There are several strategic reasons why a company would consider buying back its own shares. One of the reasons why a company might consider buying back its own shares is to increase share value. By reducing the number of outstanding shares, a company can increase the value of the remaining shares. The second reason why a company might consider buying back its own shares is to improve its financial ratios. Ratios such as earnings per share and return on equity can be improved through share buyback. The third reason why a company would consider buying back its own shares is to utilize excess cash. Companies with excess cash can decide to buy back their own shares instead of paying dividends or utilizing that cash in other projects. The fourth reason why companies would consider buying back their own shares is to prevent hostile takeovers. Companies can decide to buy back their own shares and reduce the number of shares in the market to reduce takeovers. Now, let us look at how treasury shares are accounted for in a company's balance sheet. When a company buys back its shares, the cost of those shares are recorded in a contra-equity account called treasury stock. This reduces total shareholders' equity. It is important to note that treasury stock do not carry any voting rights and do not earn any dividends for as long as they are held by the company. Now, let us look at the impact of share buybacks on existing shareholders. When companies buy back their shares from the market, existing shareholders have an advantage. The value of their shares often increases. However, it is important to note that share buybacks can be a signal of a lack of profitable investment opportunities for the company. You might be wondering if a company can reissue back treasury shares. Yes, they can. Companies can decide to reissue treasury shares in the future for various reasons, such as raising capital. Companies can raise capital by selling back the treasury shares back to the market. The second reason why companies can reissue back treasury shares is to use as employee compensation. Companies can decide to deploy treasury shares as employee compensation in the form of stock options or other employee compensation options. Companies might also decide to reissue treasury shares in mergers and acquisitions as part of their payment to other companies. I hope you have enjoyed this video. In our previous video, we talked about ordinary shares. Go and watch it if you have not watched it. Thank you guys. Kindly subscribe.